Hi, everybody. Welcome back to my channel. This is Oliver Wiedmaier at Ollie underscore all caps on Twitter, the founder of Voyage Trading Group. Voyage Trading Group is a new group I just created. It's on Discord. It's completely free, and it's an interactive chat room where advanced traders and beginner traders come together and share ideas, pre-market ideas, post-market ideas. There's a lot of education that happens. There's resources, there's links to books, links to videos. It's a lot of fun, and the beginning traders are getting a lot of benefit out of it, and also the advanced traders are getting a lot out of it because you guys are holding us accountable. So it's a lot of fun. If you want to join, link is down in the description and also in my bio. And now I present to you my risk reward bell curve presentation. This is a risk management tool that I've developed that's completely transformed my trading. My equity curve used to have high highs and low lows. I was a boomer bust trader. Now, after developing this tool, my main focus when trading is on risk and my bell curve. And so we'll just dive into it now. So what is an RI bell curve and why do we use it? It's a tool used to track the return on risk, and it counts the number of closed trades based on return on risk, and it will help you identify a theme in your risk management. So this is 3 examples of risk management on 150 trades. One on the left is what your bell curve would look like with poor risk management. You can see that you have a lot of trades on the right side of the curve and not that many on the left side of the curve. That means that you have more negative trades than you do positive trades, which means you have poor risk management. Now, if your bell curve looks like this, you have a lot of 0 trades. You have quite a bit of 1R trades, and then you have more trades to the left. You are favoring the higher end of your risk reward. This means you're a professional at risk management. Now, if your bell curve looks like this, you probably are just breaking even, which is totally fine. It doesn't mean that you are bad at risk management, but you're not necessarily getting ahead on your equity curve, which means you need to improve your edge. So this is 3 examples, all calculate to 150 trades. Let me explain a little bit further what that means. So how do we define risk? So your total risk is going to be the amount of money that you will lose if your stop loss is hit, and it should be based on your account size. For this example, if you enter at $86.10, the low of the day is $83.32. You subtract 83.32 from 86.10, so you're risking $2.78. And so what you want to do is you want to divide your risk by the trade risk. So for an example of a $25,000 account using a 0.5% risk, you would divide 125 divided by the 278, and you would buy 44.9 shares. So you would buy 50 shares. So just using this calculation, you are identifying exactly how many shares to buy. You have your risk in mind, and you will be able to enter this trade knowing that you will not lose more than 0.5% of your account if your stop loss is hit. So something that's very important is knowing your numbers and knowing your position size. So if buying 45 shares would cause you to have too much of a large position, then just knock your position down. So instead of buying 45 shares, maybe 35 or 30 shares. So how do you create your bell curve? Well, what you want to do is you have to log your closed trades. So this is just an example. You have your ticker, number of shares, your entry price, and your exit price. And then for this example, you put in your gain, and then you manually put in your RR. So what does that mean? Well, again, using a $25,000 account with a 0.5 risk, 1R would be $125. 2R would be $250. So if you enter a trade and you make $250, you would log in your tracker that you made 2R trade. If you, for whatever reason, you made your stop too low, or you were messing around and you went bigger than you should have, and you had your trade at a negative $250, so you would have made a negative 2R trade. So you just log it in this column. And so what this does here is it just counts the number of closed trades on this graph here. And so what are some strategies to improve your bell curve? Well, you want to limit the number of open positions. You want to use a low of the day as a stop. And whenever you reach 1R, you want to take off 33% or 50% off. Continue to reduce risk when multiples hit. So after you take off some risk at your 1R, once you've hit 2R, you would take off some more. Another thing, depending on the environment, if it's just really difficult to make 2R, 3R trades, you might want to consider moving your stop to break even once you've reached the 1R so that you are not necessarily hitting 2Rs and 3Rs because the environment's not letting you, but you know that you're hitting a lot of break even trades or 1R trades. And enough 1R trades will help move that equity curve up. Well, I hope this helps. If you have any questions, please contact me either in the comments or on Twitter. Thank you.